Alright, okay. Traders, good evening. Good evening. Right, this is our live session. Today we'll be looking at analyzing the markets and then looking at what we have coming for the week. So my chart here is GJ, British Pound, Japanese Yen. Okay. So what I'm going to do is to start from the daily time frame and then quickly go through it, and then so we're doing a top-down analysis starting from the daily time frame to be able to identify where price is heading towards in order to be or to pick the right bias, whether it's uptrend or downtrend. So currently this is what we have on the daily time frame. So looking at the chart from this point onwards, let me pick looking at the chart from this point onwards, so we're going to read it from this point onwards. So from here we can see it's made this low, we traded to this low point, and then if we look to the left we'll find the reason why it traded to this low point and then began to make its way up. But again, we'll look into that later. So now what you want to identify is a breakup structure and then some demand areas where price originated from as it made its way up. So over here we can see there's a breakup structure here. Oops, this is too big. Okay. Alright. So let me change this here. Okay. So there is a breakup structure right here. So I will indicate that. So we have, so as I said again, this is the daily time frame, so we want to mark it out and then we'll drop it down to refine it as we go along. Refine it. So we have another breakup structure here. We have another one here. Okay. Alright, so we have this breakup structure here. So now we've identified them, so we need to mark the areas where these originated from. So the first one we marked here originated from this level. Let me pick the arrow. So come on. Okay. So with this breakup structure, it's originated from this candle. So I'll just pick the high of this candle here and the low of it to indicate the area we are referring to, or the demand area. The demand area. Okay, so that's that one there. Then we have another one, this breakup structure here. We have another one here, so we'll mark that one as well. Pick the high to the low. So this on the daily time frame, so we will go down to the smaller time frame to refine what we have marked on the daily in order to help us identify where our point of interest is. So over here, this is currently where price is at on the daily. So we had a breakup structure here, and then with the breakup structure we can also see some imbalance here. Okay, so what I mean by imbalance is there are places where, or these are some institutional reference points that we trade with. So once you identify a demand or supply zone, and then if you're able to identify an area of imbalance or imbalance connected to that demand or supply zone, it makes it more powerful point of interest to take note of, because most of the time we trade to that area and then price takes off. So what's an imbalance is, if you are new to this, is basically if you take three candles going down like that, have got a wick, and another candle going down. So this is where this candle closed. It came down here, pushed up and closed here, and the next candle started from here. Probably gave a little wick here, and the next candle continued going down, came down here with this wick, and then push up and close at this level. So the next candle also continued from this point on. I'm just using this as an illustration to better explain what an imbalance is, or what a fair value gap is. So over here we can see that we traded to this low on the first candle coming down, first bearish candle. We traded to this low. So, and then after price traded to this low, it pulled back close here, and the next one opened and traded down as well. But we're referring to the wick of these candles. So this is where the low of this candle here, and the third one, so the middle one is the second candle, the third candle is this one. So the third one also opened, traded up here, and then left a gap in between the low of the first candle and then the third candle, also traded up here and then pushed down. So all that we are referring to, or we are concerned here, is this gap between these three candles. Let me change the color so that, so referring to this gap from here to here. So that is what is called an imbalance, or a fair value gap. So on the charts, we will identify some of these things as we go along. So so just take note of it. If I make mention of it, this is what I mean by an imbalance. And also referring to a demand and supply area. So these are demand areas that I'm just marking on the charts, and then we'll get to mark some supply areas as well as we go along. Okay, so let's crack on. So let me mark on the charts the actual imbalance area that I'm referring to. Let me clear this out first. Okay, so we have here the low of this candle, which pushed down after this big move. So this is the low of it. So we're going to pick the low of this first. So this is from the illustration I made earlier on, that was a bearish move. So over here we have a bullish move. So we have this first candle, second and the third one here. So the first candle also traded up to this point, leaving this gap in between these three candles here. So there wasn't any interlocking. So for the market to be efficient, normally you should have price trading up to meet with this wick here to close that gap. But over here we had this fair value gap, or the imbalance left here. So if we identify an imbalance associated with a demand area or an order block, it acts as a very powerful area or a very powerful point of interest to consider. So currently we have traded from this point on to the imbalance area. Let me indicate on there as well. So from this point to this point we have an imbalance. I'll use a different color to make it clear. Okay. Yeah, so this on the daily. Let's go on to the, so there's another area of imbalance here as well. Let me mark that as well. So if you have a demand area where there is an imbalance attached to it, very powerful area to consider. So we go to the 4-hour time frame to see how we can refine this kind of movement. So the 4-hour time frame, you can see over here, after this area we marked, we had a push up which had a break of structure. This is the area that I marked on the daily time frame. So we came back into the imbalance, tested that area, and then pushed up. So from this point on, we can see that price is making higher highs and telling us that this is an upward trend. So the same way we have here. So now we're going to concentrate or focus our attention on this recent area where we had this push up. So currently this imbalance we identified on the daily time frame, that is where price is tapping into now. So the market is will be opening maybe in the next 45 minutes or 40 minutes, or maybe we open later tonight. So as we can see, we have a high chance of price pushing up to this previous high. Okay, we can also identify a break of structure here. But as we know, we are in a bullish market. The bias is more of on the buy side. So we will see how price reacts from here. So over here, let's see how we can refine the areas we marked on the daily. So the demand area is where the last area before the impulse move, that's where we mark or you map out. So on here, the last point before the impulse move was here, because this push down, it's a halt, which is not more of a, it's not a break of structure, it's a halt because the retracement is not that big. So for it to be considered as a retracement, I should have at least 3 candles pushing down. So over here we had only 2, and then here we have at least 3 candles. So this is a break of structure here. We identified this one on the higher time frame, and then on the 4-hour there's another break of structure here. So we will refine this area to this point on, So currently the area we are referring, price is testing is this area of imbalance. So we can be on the watch out and then see how price will react from this point on. If it gives a buying event or gives us an event to buy from this point on, we'll take it from here. So as we identified it on the daily time frame, it's we are in a bullish market. So let's go to the 1-hour charts. Let's see. Right. So on the hourly charts, this is what we have here. Okay. So from this point on, we can mark here what we are more interested in areas where price originates from and then break a structure. So we have an internal break of structure here, a tiny one from this point on. So as we see here, there was a push down and then price broke above this area. So this is a break of structure. So once we identify a break of structure, we have to also identify the origin of it. So as this area, we identified it on the higher time frame to be an imbalance area where price tapped in, pushed up, then it came back for a retest. So we can take this as the origin of this break. Okay, let me clear this chart a little bit. Okay, so on the 1 hour, this is the origin of this break of structure. Let's see if this one gave us a break again. Okay, so we don't have a break of structure here. So we'll see how the market plays out. So this we identified as an area or point of interest. So if it gives us an entry here, entry event here, what we'll do is we'll just take a buy from here, and then we're targeting the previous high. So this is what we expect on the, we kind of looking forward to happen on the gold GBP JPY. this is what we're expecting to happen on GBP/JPY as the market reopens. So let's be on a watch out for this. Let's be on a watch out for this. So this is the potential entry. The stop loss goes just below the previous low. So what you have to do if you want to take this trade is to apply proper risk management. So the entry time frame is 15 minutes, which I've put it on here. Entry time frame is 15 minutes. So on the 15 minutes, I can identify a break of structure here as well. A break of structure here. So the origin will be from this point on. A break of structure on the 15 minutes. So the origin, so if price gives us this pullback to this origin here, it will be a nice entry too, as it's already tapped in it, but if it gives us another push down here, it will be another opportunity to take this to the upside. Okay, so this is on GJ. So let's look at probably gold. Let's look at gold. So the same thing, we go on the higher time frame. Go on the daily charts, and then we see how gold is pushing up. So if we look at it from this point on, we had a break of structure here. So what I'm using here is institutional reference points, which they call it order block or demand and supply area. So this area that I've already marked is an origin that I've marked here. So we have a break of structure right here. This is a break of structure. So this is a break of structure we have right here. So the idea is, once you have a break of structure, you expect price to come back to that zone to test it before pushing up, or to continue the upward move if it's in an uptrend. So this gold has been in this upward trend for some time. We have another break of structure here. Another break of structure here. Another break of structure here. And then, as we can see, the origin is right from here. Let me mark the origin of this push up. So the last candle happens to be the place we are looking out to mark. And as we also looked at having or identifying some areas of imbalance attached to those area of interest, so we can identify these imbalances here. So with what we are seeing here, you can see that we traded into the imbalance and then started pushing up again. So currently gold has traded to this area where we have this trend line that it respected it before. So now this is where we traded to on last Friday. So hoping if this area gets respected again, we can expect another push down to to this zone, to tap into this zone before we either push up or we break below this zone to go further down. So what's price like doing, or what's attract price, that's the word, what's attract price is areas of liquidity. So this is an area of liquidity. This is an area of liquidity where this is an area of liquidity, and this is another area of liquidity, and again this is another area of liquidity. So in these areas of liquidity there is money, so this attracts price most of the time. So there's a high probability that we'll trade into this area, clearing out this liquidity and then also these imbalance areas on the chart here. So there's this imbalance, we have this one here, and then there. So there's this, so it tried to close or to fill it up, but it was partially filled. But there's another imbalance area here, which also is another magnet to attract price to this low. So what we're expecting this week is either we're expecting this week for price to push from here, maybe do something like this, back there, then test this area, So this on the higher time frame, this on the 1 hour chart. So we'll go down to the smaller time frame to refine what we have identified on the higher time frame. Okay, let me clear this out first. Let me clear this out first. Okay, so we go to the 4 hour chart. So we use the higher time frame to identify the trend that we need to go in. Already using the 20 moving average, which I have placed on my chart here, the blue line you see here is the 20 moving average, which is without doing anything, I know when the 20 moving average is rising, it's a good idea to follow it to trade up if it's by these institutional reference points. So over here we have this area supply zone here. We have this supply zone here on the 4 hour charts. We have this supply zone. So as we can see, there is a break of structure right here. There is a break of structure right here. Okay, this is more of a change in character because we've been trading down, and then there's a turn around in the market. So this is a change of character. This is a change of character to indicate that the direction has changed. So so once we mark this change of character, we then have to identify the origin of this area, this move that broke above this previous high, causing the change of character. So the origin of this move is right here, the last candle before the impulse move. The last candle before the impulse move. This is the origin, and then we can also identify some area of imbalance. So area of imbalance right here. So from this point on to this point is an area of imbalance that we can expect price to be attracted to this zone to retest it before doing whatever he wants to do again. The most recent break. So this one hasn't been tapped into yet, so it's an area that we can be watching out for, since it hasn't been tapped into yet. So there's a high probability price will tap into it sooner or later. So we have another break of structure here, another break of structure right here, another break of structure right here. There we go. So, and with this break of structure, the origin on the 4-hour time frame started from here. This is the origin area. Take this out. So that is the origin area. So this is more or less a confluence with what we will expect to look out for in terms of our trading, in terms of using the 20 moving average. This is an event right here before this move pushed up, before this move took off. So as price traded to this zone, this is a zone in itself already, so could have gotten into here, right here to the upside. So now that we have identified here to be a point of interest, a demand area or an order block, because this is the origin of this push up which broke above this area. So all we would anticipate a network right there. So I kept on clicking this. I didn't know why that was happening. Okay, let me delete. Yeah. Okay. So the anticipation is, if we get in here, our stop loss goes right below here. Our stop loss goes right there to back to the previous high. And again, we'll watch and see what happens here, because we have this area as well, and already we have identified that price has been respecting this area of supply, area of this trend line area. So there's a probability that this could just continue to this zone that we've marked here. So this is what could happen. So if perhaps we get a buying event here, we're taking it to the previous high. Other than that, we're looking at to this area as our next target area to take the trade. But currently on the 4-hour time frame, you can see it's in the uptrend. So it could happen that price will break above this area. Price will break above this area. So let's go to the 1 hour. Let's try to refine this much more. Refine this much more. Okay, so we have another area here. So for this push up or this break on the 1 hour time frame, we can more or less refine it to this candle that started a move here. So doing this will help you to get a precision entry, and then thereby reducing your risk, because on the higher time frame, once you mark it, it gives you a wider area. But if you refine it to the smaller time frame, to the point of your entry time, trading time, you get a smaller risk reward. You get a smaller risk reward. So over here as well, we refined this to this area, and then also we can identify some areas of imbalances here, there, here. Then this is another area of liquidity here, another area of liquidity where money is resting. Money is resting, and price love to trade to these areas. It becomes like a magnet where it attracts price to clear these areas and then fill the imbalances as it makes its way there. So this area hasn't been tapped in yet. We had another let me change this. Yeah, we had another break of structure here. So this is another, the immediate one that we could be looking out for. So we have this one here, we have that one here. So we go to our trading time frame, which is the 15 minutes trading time frame. Okay, so on the trading time frame, the 15 minutes, we can also refine this move here, which broke this structure. We can also identify the structure being broken here, internal break of structure. So we have this one here, right here. We have another one right here. We have this one and another break of structure. So the origin of this break here was this one where we can refine our area, our target area. So if we look to the left, we can identify that this whole area where price came to test or tap in is also a previous area of demand. Let me identify. So we have this. So we have this area here. So we can see how price traded into this area of demand, and then boom, it went with that power. So if you're able to identify some of these areas on the charts, all you do is you can set and then forget. What I mean by that is, once you identify this, you can either put an alert here to alert you when price get there, and then you go onto your chart, or you put in your buy limits, as we have identified this to be an uptrend, and this is an area where we've identified as our point of interest, as our demand area. All you can do is just come in here, put in your buy limits. Your stop loss goes right just a little bit below the area. But all you have to do is make sure you are playing within your maximum loss per trade, applying proper risk management. So this is what I'm trying to put across. So if you apply proper risk management and then you set this, and then you target the previous, this is the previous high, so that's your targets, your profit targets. The price can only do two things. It's either goes in the upward direction or downward direction, or it moves out. Okay, three things: upward and downward, and then also move sideways. But moving sideways, it will get to a point where it will still take one direction. So we've already identified the direction or the bias to be on the upside. So this happens to be a high probability trade that we identified here. So this would have been a nice move for this pair. This is on gold. Okay, so this is in the past now. Let's look at what we can identify as the market opens, where we can. So currently we've identified this area of demand. It's a break of structure here, a break of structure here. So with this current break of structure, we just have to mark the area of demand. That is the last candle before the impulse move. So this one here looks to be a little bit. Okay, I'll take it from here. Yep. So let's see if we can identify an area of imbalance. So we have, after this impulse move, we have this from this point to this point. Has it been filled? So we have this imbalance here. Imbalance here. There. So we have an area of imbalance where price traded to kind of fill it up, but it's, I would say it's not fully filled. So this area now acts as an area of liquidity where we, as I said earlier on, it's something to attract price. So what I'm expecting, at least, for price to drop down to this area before another push up. If it wants to continue the up move. So we are not here trading what we believe, what we think, what we feel. We are not trading our feelings. What we are trading here is what we see on the charts. What we see on the charts is what we are trading. So your feelings should be out of the door, or should be outside, should be waiting outside. When you finish trading, then you can grab those feelings and then make do with what you want to make do with. But with regards to trading, it should be rule-based trading or mechanical trading, where you analyze the chart and then what the chart tells you is what you do. What the chart tells you is what you do. So let's keep that in mind, and also keeping in mind whatever position you take, not playing at all with your risk management, because whatever capital you have, you need and you must protect it. That is what will keep you in the game for a long time. So if you don't protect your capital, you might not have another opportunity to take another trade. So that's why it's always important to know how much you are risking per each trade, which it shouldn't be more than your maximum loss per trade. It shouldn't be more than your maximum loss per trade. So you have to play within that risk. And then once you play within that risk, that will do away with fear, because you've already accepted the risk for taking that particular trade. For example, taking a trade from here, taking a trade from this point on, to what to maybe to, for example, to this high, you put in this risk below this previous low. So if from here to this low, which is your risk amount, is more than your maximum loss per trade, then you might have to reduce your lot size. You might have to reduce your lot size. So if, for instance, you are taking a one lot position on this particular trade, and your risk amount is, let's say, 100 pounds, and with that 100 pounds, from this area of from your point of entry to the risk area is 150, then you have to reduce your lot size to fit within that 100 pounds, to pick a lot size that will give you either exactly 100 pounds or below 100 pounds. So that way you are playing within your maximum loss per trade. So that will give you an opportunity. So if, for instance, that lot size is from your is supposed to be 1%, you shouldn't risk more than 1% of your account anyway. So if that 1%, calculating using your account size, will give you at least, let's say, 10 opportunities to take a trade before if it goes to the opposite side, or it goes the wrong way, it will completely take you out of trade. Then you have that 10 trades to take. You have those 10 opportunities to risk on any particular trade. So if, for instance, you risk 1% on any particular trade, or less than 1%, then you get one trade that takes you into profit. Let's say it gives you 3R. So basically you're risking 1 for 3. So you're making what do you call it? 3 times your risk, which is a good thing. So we have to look into this with every level of carefulness as we go into this journey, as we go about this journey. So I believe this has given you some insight into trading, or given you some level of understanding as you joined me today with this quick analysis of these two pairs that we've looked at. So the idea is for you to identify the main trend, the main direction of the chart. So you go on the higher time frame, you mark your demand or supply zone, and then you drop down on so from the daily you pick those key areas, and then you drop down on the 4-hour to refine that area. You drop down to 1 hour to further refine the area. Then you drop down to the 15-minute time frame, which is the time frame that I'm using to enter the trade. So once I get to that area, to the 15 time frame, I would have refined the area to a very smaller area compared to the bigger area I identified on the higher time frame. And then by so doing, I'm able to have a sniper entry and also have a smaller risk of that particular trade that that you're looking at. So over here is just an illustration. We have here a break of structure, so a break of structure here, so all you have to do is trace back to find the last candle where this impulse move originated from. So all you have to do is to take the high of that last candle to the low of it. So this now become your demand area or your order block. So in identifying this, also check and see if there is an impulse imbalance attached or closer to this area, which makes it much more high probability area to attract price to. So we have this area. This is the origin of this move that broke this structure. We have another break of structure here. So all you do is you pick and then you find that zone. So with time, as price goes on, we expect price to pull back to test this area before making the upward move again. So this is where we target to take our trade, making also having this in mind. If there's no retest, no entry, no retest, no entry. So once there's a break, you wait for the retest to our target zone, the location, and then once price get to the location, you can either use buy limit or stop sell limits there. You set and you forget it. So price can only do two things: either hit your stop loss, which you have already accepted, so there shouldn't be any fear. It shouldn't kick you off balance, because if you already accepted the risk, you getting hit on your stop loss shouldn't kick you off balance. So price can only do two things: either take you out on your stop loss or push to your take profit. So once you enter here, your take profit is right here to the previous high. Right. Okay. So this is meant to be for an hour. So it's almost 10 o'clock. It's almost 10 o'clock. So I believe you'll find more value in this video. You'll get some value as you sit and go through what I've gone through with you. So any pair that you want to you trade on, you pick it and then you go through the same process, and then you should be making some money. Also using the moving average. You can also use the moving average to help you identify the direction that you ought to trade. So once you have the 20 moving average on the charts, with all this analysis, sometimes you may think or you may have some doubts. So with the 20 moving average on the charts will also help you to get the right bias and then follow it up. So whatever it is, you can do some back testing on this and then see how it will help you in your own journey as you go about trading. So without much to say, thank you very much for joining me today, and then have a lovely evening, and then hope to catch you up again on the next live session. Thank you, and then see you next time. Thank you.